Hello everybody. This time we are talking about revenue in business. Revenue, often called gross income, refers to the cash inflow generated by a business from its primary activities. These activities include the sale of goods, provision of services, or other transactions that result in the organization of income. In accounting terms, revenue is the top line of an income statement, representing the total amount of money earned before subtracting expenses, taxes, and other deductions. It is essential to note that revenue only includes receivables in the current period. This means that the revenue reported in a financial statement corresponds to the amount paid to the company during a specific reporting period, such as a quarter or fiscal year. The accounts receivable, which is a separate line item on a company's balance sheet, may include the entire cost of the goods or services rendered during the period. However, the revenue figure will only reflect the amount received by the business within the reporting period. And then we move to difference between revenue and profit. Profit is the financial outcome that remains after subtracting all expenses from revenue. Unlike revenue, which represents the total earnings of a business, profit provides a more accurate measure of its financial health. It accounts for all the costs associated with producing and selling goods or services, often referred to as the bottom line on the income statement. Profit is calculated by deducting expenses from revenue. And then we move to revenue formula. The revenue formula may be simple or complicated depending on the business. For product sales, it is calculated by taking the average price at which goods are sold and multiplying it by the total number of products sold. For service companies, it is calculated as the value of all service contracts or by the number of customers multiplied by the average price of services. The formulas can be significantly expanded to include more detail. For example, many companies will model their revenue forecast all the way down to the individual product level or individual customers level. And then we move to types of revenue. There are two types of revenue. The first type, operating revenue. Operating revenue is revenue your company earns from its main business activities. For example, sales to customers are operating revenue. And then the second type, non-operating revenue. Non-operating revenue is revenue your company earns from activities that aren't directly related to your business. For example, you might earn non-operating revenue from investing or renting your building to another business. And then we move to effective strategies for maximizing revenue. The first strategy, optimize pricing. One option is to assess the current pricing strategy and determine if lowering or raising prices could make a meaningful difference in total revenue. Again, raising prices to a certain degree to keep pace with inflation and properly reflect the value offered can be a solid way to drive revenue growth. However, companies need to avoid raising prices too high, which impacts consumer demand for the product and result in fewer sales. And then second, engage in promotional activities. If companies need to increase sales in the short term, it may be wise to engage in a promotional strategy. Sales and promotions should be used wisely, and they are a sustainable way to increase revenue over the long run. However, they can be highly effective and motivate customers to pay. And then third, conduct thorough market research. Businesses should also evaluate their product or service offerings and determine whether there's ample market opportunity to drive sustained revenue growth. It's certainly possible to operate a sustainable business in a mature market. However, it's worth assessing if the business has the right product market fit or whether it needs to pivot, adjust its offerings, or enter a new market. And then fourth, utilizing technology to manage incoming payments. No matter if you're just starting out or a long-standing business, implementing digital tools to automate accounts receivable management can help you streamline operations and receive payments for accrued revenue faster. And then who needs to understand revenue? Every business owner needs to understand sales revenue because it helps drive growth. Keeping track of it will provide insight into how well a business is doing and whether sales are missing and rising or falling. It is one of the most important metrics for any small business and an integral part of understanding business finance. If you understand revenue, you make adjustments where necessary to improve cash flows, net income, and increase revenue growth. It is also important to have a good handle on it when applying for finance, as investors will want to know this figure. And then we move to classifications of revenue. There are the two ways companies classify revenue. The first, gross revenue. Gross revenue is the total income earned within a period, typically a year. It doesn't include expenses such as the cost of goods or salaries. Companies typically calculate gross revenue at the end of a time frame and use their findings to plan for the next period. And then second, net revenue. Net revenue refers to the total money earned from business activities after accounting for expenses. These expenses may include employee salaries, discounts, and rebates. And then we move to sources of revenue. The first source, sales revenue. Sales revenue and the cornerstone for most businesses is the income derived from selling goods or services. It forms the primary financial stream and is critical for business viability. And then second, interest and dividends. Income from financial investments such as interest accrued from savings accounts or dividends from stock holdings represents another revenue source. This type is more passive and dependent on investment strategies and market conditions. And then third, service revenue. Service revenue is generated by providing specialized services. This is a common revenue source in the consulting, legal, and healthcare sectors, where the expertise is monetized. And then fourth, licensing and royalties. This revenue stream arises from granting rights to use intellectual property, including patents or copyrights. It is common in creative industries, technology, and research sectors. I think it is enough. Thanks for watching.